Hello, everyone, and welcome back to the Commodities Institute podcast. I am your host, Emily Costa. It is Friday, January 16th, 2026, and we have an incredible amount of ground to cover today. From the gold mines of West Africa to the wind farms off the coast of New York and the struggling cornfields of the American Midwest, and the commodities world is moving at a breakneck pace. We are seeing a massive realignment of how resources are managed, taxed, and traded. And today we are going to break down exactly what that means for the global economy. We have to start today with a major development in the metals sector coming out of Ghana. For decades, Ghana has been a titan in the gold industry, but the government is now signalling a massive shift in how it deals with international mining giants. Isaac Tando, the acting chief executive officer of the Minerals Commission, has revealed that Ghana plans to scrap those long-term mining investment stability agreements that have been the bedrock of the industry for years. Essentially, these pacts locked in tax and royalty terms for 5 to 15 years. But the government says these agreements have been abused, with some companies allegedly using revenue from Ghana to buy mines elsewhere, while failing to meet basic local obligations. Now, they are looking to double royalties. We are talking about moving from a 3 to 5% range to a sliding scale that could hit 12% if gold stays above $4,500 an ounce. With spot gold currently trading around $4,590, this is an immediate and massive change for companies like Newmont, AngloGold Ashanti, and Goldfields. It marks a growing trend of resource nationalism, where governments are determined to capture more value while bullion prices are high. Staying with metals for a moment, we are also watching a potential earthquake in the corporate world. Rio Tinto and Glencore are back in early merger talks. If this goes through, it would create the world's largest mining company with a market value of more than $200 billion. But there is a huge hurdle in the way, and that is China. As the top commodity buyer, Beijing is incredibly concerned about market concentration, especially in copper and iron ore. History tells us that China won't let this happen without a fight. Back in 2013, when Glencore bought Xstrata, Chinese regulators forced them to sell the Las Bambas copper mine in Peru to Chinese investors. Analysts expect a similar playbook here. We might see Rio Tinto forced to sell off assets like the Simandou iron ore mine or the Oyu Tolgoi copper mine to friendly entities just to get the deal over the line. Moving from the earth to the sea, let's talk about the high-stakes battle over renewable energy. A federal judge in Washington, Carl Nichols, just handed a major victory to the Norwegian developer Equinor. Last month, the administration of President Donald Trump halted 5 major offshore wind projects, citing classified national security concerns regarding radar interference. However, Judge Nichols ruled that Equinor can resume work on its New York Empire wind project. He argued that the irreparable harm to the project, which is already 60% complete, and has seen $4 billion in investment, outweighed the government's vague national security claims. This is a temporary reprieve, but it is a massive signal to the industry. At the same time, the White House is hosting a group of governors today, including Democrats like Josh Shapiro and Wes Moore, and Republicans like Mike DeWine and Glenn Youngkin. They are meeting to sign a deal intended to curb rising electricity costs, specifically targeting the massive power demand from AI data centers. The plan includes price caps for 2 years on future auctions in the PJM grid, which covers 67 million people. It's a fascinating push and pull between the need for new energy infrastructure and the political pressure to keep consumer bills low before the midterm elections. Now, we have to turn our attention to a very sobering story unfolding in the heart of rural America. The US farm economy is showing some really widening cracks. Despite producing massive corn and soybean harvests this past fall, farmers are drowning in a global glut of grain. The numbers are frankly startling. The United States Department of Agriculture estimates that corn prices are around $4.10 a bushel, but a farmer needs $5.03 just to break even. For soybeans, the break even is $12.80, but they are fetching only $10.20. This has led to a 36% jump in Chapter 12 bankruptcies in the first 9 months of 2025 compared to the entire previous year. We are seeing a ripple effect through the whole community. Equipment makers like Deere and Company have laid off more than 2,000 workers, and there are even reports of a surge in combine fires in Kansas because farmers can't afford the maintenance to keep their old machinery clean and safe. While the US struggles, Brazil is moving in the opposite direction. Their crop agency, CONAB, just confirmed a record soybean crop of 176.12 million metric tons. Most of that is headed straight to China, which has turned away from US soy to avoid retaliatory tariffs. The energy markets are also seeing a massive reshuffling, particularly in oil. In Venezuela, the doors are swinging open again. Major players like Spain's Repsol, Italy's Eni, and France's Morel and Prom are applying for US licenses to export Venezuelan oil. This follows a 50 million barrel crude supply deal between Caracas and Washington, which is the first step in a $100 billion plan to reconstruct Venezuela's oil industry. It's a complete pivot from the sanctions of previous years. Meanwhile, halfway across the world, India is changing its tune on Russian oil. For a long time, India was the top buyer of discounted Russian crude, but Western sanctions and a 50% import tariff from the US are taking a toll. Russian imports to India dropped 22% in December to 1.38 million barrels per day. As a result, OPEC has regained its share of the Indian market, rising to over 53%. It shows how quickly geopolitical pressure can rewire the world's most critical supply chains. Finally, we have to look at the dry freight and grain shipment forecasts coming out of Europe. The consultancy Expanner has cut its forecast for European Union soft wheat exports for the 2025 to 2026 season to 28.8 million metric tons. Sluggish shipments from Northern Europe and stiff competition from Argentina, which is sitting on a bumper crop. However, they are expecting a recovery in yields for the 2026 harvest, projecting a soft wheat crop of 128.6 million tons. On the buying side, Turkey has been busy. Their state grain board, TMO, just provisionally bought 210,000 metric tons of feed barley. They are paying about $259.50 a ton as they try to stabilize local prices after a disappointing domestic harvest. It is a world of contradictions right now. Record production in some places, financial ruin in others, and a constant shifting of the legal and regulatory goalposts. Whether you are looking at the price of gold, the cost of power, or the flow of oil, the common thread is a move toward more local control and a very complex dance with global sanctions. Thank you so much for joining me today for this deep dive into the state of commodities. If you found this episode valuable, be sure to subscribe, share, and leave a review. I'm Emily Costa, and this has been the Commodities Institute podcast.